You know, the ETF has become so big and so powerful. I think, quite frankly, it's very disruptive to the market. I mean, you know, one biotech company, just one company, announces something maybe not terrific or bad, and every biotech stock goes down, and people scratch their head and say, well, my company's doing great. Why is mine going down? And I'm telling you, it's because the ETFs, they're hitting the sell button, and they're selling the biotech ETF, and all the stocks are going down.
Well, what people don't understand about these exchange-traded funds or ETFs is about half, or maybe even 55 or 60%, are owned by financial institutions, big financial institutions, and the trading volumes are astounding. The original SPDR, Standard & Poor's first ETF fund, which is the biggest of all ETFs, around 160 billion of assets, is the most widely traded stock in the world every single day, that ETF. And it turns over at about 7,000% a year. And I'm the kind of guy that thinks turnover of 5% is sort of pushing the envelope.
It's a little crazy. Yeah.
Yeah, really, it's a trading frenzy with the ETFs. They create that. And then you have, you know, the traders who are trading in, you know, milliseconds and all that. I mean, and then, you know, we look at your books.
Nanoseconds.
Nanoseconds. Yeah,
that's old-fashioned.
That was
it's too slow.
That's so whatever
That's
from years ago. And then, you know, your books, the things that you say, I think are just can help calm markets. You know, there's too much news being thrown at everyone. You know, the 24/7. When I was first in the business, I would have clients call me during the day and say, "What's the market doing?" Yeah,
Right.
They know they know around the clock what the market's doing. It makes them nervous on many occasions, and might make them be traders when they should be investors. And I think your influence, the words in your books and everything is sort of be long term. Don't try to time the market, and I just think, you know, that it's just a plus for the market that people listen to you.
We're so focused on the markets, which jump around for one reason or another. It's often speculators trying to guess what other speculators are going to do.
What's he thinking?
What's the point really of all this? Because in the long run, the movements of the market account for 0% of the return on stocks. It's what corporate America produces. And that's the current dividend yield if you're investing today, and the subsequent earnings growth. And that's going to tell you what we call the investment return on stocks. The stock market is a derivative of the value created by those corporations. So it's foolish to even look at it. Now, we can't break ourselves of the habit. It's fun. Yeah. It's like going to the casino, and you're guaranteed to lose if you play it long enough and heavy enough. And, you know, I've said in one of my books, I think it was a pretty good expression, by the way, the stock market is a giant distraction to the business of investing. I mean, you know, when the stocks go down 250 points, what did the value of corporate America do today?
Right.
Well, the dividend remained pretty much unchanged. The potential earnings growth was certainly the same as it was at the end of the day as it was at the beginning of the day.
Yeah.
So the basically investment return has been unaffected.
Let's begin with something that you said years ago about ETFs, that ETFs are like giving an arsonist matches. Do you still feel that way today?
Yes, it's even worse today, actually. ETFs, using the proper ETFs and using the proper ETFs in the proper way is a perfectly intelligent strategy, just so long as you don't fall for their basic selling proposition, which is you can get out of the market in the middle of the day, any time you want to get out, real time. Sell them in real time. There's this terrible investment strategy, but you don't need to do that. The temptation is there. But ETFs, like the original traditional index funds, do offer total stock market, S&P 500, international market, total bond market, maybe even emerging market. And they're perfectly intelligent ways to own them, just so long as you don't trade them. But ETFs make it possible to trade them momentarily, so they're no better than anything else, and they have the temptation to be worse. You know, I'm going to guess, Ron, that out of 1,400 and 1,500, I guess, ETFs, there are maybe 40 broad market ETFs. That leaves you 1,460 that are, in many respects, kind of fruit and nut cakes.
Right. Final question. If investors are going to use ETFs, what is the right way to do that?
By the broad market indexes and not these crazy things like triple inverse leverage like commodities, even like gold, and very narrow, the Korean market or the single country or a tiny industry segment. The more specialized it is, the less I like it. So the choice of ETFs is the large, broad market ones, and the way to use them for the individual investor in all cases is not to trade them. So buy and hold, buy and hold, buy and hold.